most of this gold and silver will be removed from these bank custodial vaults in London and New York and moved into private safekeeping. And that's where I think we could really see upside fireworks. Greetings, land of Arcadia economics, and welcome to another episode of my bi-weekly podcast that I do for Arcadia economics. I'm recording this on Wednesday, right after the stock market closed and after the FOMC policy statement release circus. As everyone's well aware, the market went through its usual silly volatility gyrations surrounding the words and sentences of the Fed. The net result of it is they hiked the Fed funds rate another 75 basis points, and contrary to the perma-bull aspirations, the Fed did not leave any room, at least so far, for it to pivot anytime soon from its current monetary policy. However, just as silly is the fact that people are attributing the sell-off in gold and silver to the fact that the Fed is hiking interest rates and the dollar is soaring. Now, it is true in one respect when you segment out the gold and silver market into the paper derivatives BS market and the actual physical market. And what I mean by that is there are no large sellers of physical gold and silver out there. And that's not why the price of gold and silver is being driven down. In fact, if anything, central banks have been accumulating a record amount of gold this year. And some of the largest buyers, large country buyers like China and Turkey and, of course, India, have been buying gold, physical gold recently, hand over fist. And as Ronan Manley has shown with his great work on the drain in the silver stock in London custodial vaults, a lot of silver has been removed from those vaults and is being imported by India. So the action that you're seeing on the screen is in the paper market, and it's being driven by the banks, which have always been there manipulating the price of gold and silver and keeping a lid on it. And recently the hedge funds, and the hedge funds right now are much more responsible for the sell-off in paper gold and silver and that's the price that we observe on a daily basis in the market than the banks have been. And I'll show what I mean by that in a second. But in terms of, the idea that hiking interest rates is the cause of gold and silver selling off, I just wanted to give you guys a quote from Alasdair Macleod, who I'm sure everyone knows who that is. He does phenomenal research and writes phenomenal commentary at goldmoney.com. And in his most recent piece, he had a quote that stood out. And he's talking about the idea that hiking interest rates is driving down the price of gold and silver. And he said, the last time we had a true inflation scare was in the 1970s, when gold rose from $35 to $850, while U.S. prime rates rose from 4.5% to a record 21.5% in December 1980. Well, so much for higher interest rates driving gold prices lower. And as I've referenced before, Adam Hamilton's done a fantastic statistical analysis going back to the early 70s, showing that when the Fed starts hiking the Fed funds rate, that's when gold has its best periodic rates of return. So I do expect at some point that this current downtrend, which really has been in place since August 2020, is going to bottom, and it may be starting to bottom now, today's action notwithstanding. Especially, I think we're seeing it especially in silver. And I think it's going to be the physical market that drives it. So I wanted to just show what's going on in terms of what I think is going on with the hedge funds. And it really we know that the hedge funds have been short silver for most, since I think July is when they ended up going net short COMEX silver, and the banks started to go net long, and that's been well documented. This chart, I plot gold, which is the continuous COMEX futures contract that Stock Charts uses, versus the dollar index. And I went back a year, and you can see here, as the price of gold has been falling and the dollar has been rising, and this is right around the time when the Fed started hiking interest rates. And so what I believe is going on is, as the dollar, on days when the dollar shoots up and weeks when the dollar shoots up, the hedge funds are in there shorting paper gold, COMEX gold futures, I think the hedge fund algos are programmed to do that because, right, everyone knows when the dollar goes up, gold goes down. And this has been pretty constant for at least the last 6 months. And I wanted to note right in here, this is about the time frame where the hedge funds went net short paper gold on the COMEX, and that's per the Commitment of Traders report. And I'll get to that in a second. So what you have is a situation where the hedge funds are set up extraordinarily short paper gold, and I'll show you those numbers in a second. And they are also short paper silver, although not as short as they've been, over the course of the time since they've been net short paper silver, which, as I mentioned earlier, I think was around July. The banks are net long paper silver, which is interesting. And I don't know if they've ever been net long paper gold. There may have been a brief instance over the last 20 years when that's happened, but they're aggressively covering their paper gold shorts. So we're kind of set up in a situation where if the Fed flinches even a little on its monetary policy, and I don't think it's going to take that for a bull cycle in the metals to start again, but there's potential for an explosive upside move that will initially be driven by hedge funds scrambling to cover their shorts, and they'll flip to net long because that's what they do. Their hedge fund algo programs are programmed to chase momentum. And the banks will also massively cover their growth short positions. Again, I don't know if they'll ever go net long paper gold. And then this will be followed by, or maybe even at the same time, an intensified scramble for physical metal. And most of this physical metal from buyers, and I'm talking about wholesale buyers, countries, central banks, wealthy entities, as well as retail buyers who buy from coin dealers. Most of this gold and silver will be removed from these bank custodial vaults in London and New York and moved into private safekeeping. And that's where I think we could really see upside fireworks. And I don't know what kind of time frame this is going to happen in. Let's just say sometime within the next year, but I think we're going to start to see the precious metals move higher much sooner than that, and possibly before the end of the year. Now, one thing I wanted to point out on this chart is you can see gold has made a nice, it's holding a bottom here, it's holding a low, and I think this is either near or close to the low. Oh, it is, since it is the low since August 2020. And the momentum indicators, the RSI is in a nice uptrend, and the MACD is in an uptrend. Although, again, of course, it doesn't feel like that with gold doing what it's doing price-wise. I should say paper gold, which I think is directly tied to what the dollar's doing and how the hedge funds are playing it. This is the Commitment of Traders report as of, well, it was released last Friday, October 28th, and it's as of Tuesday, October 25th. Unfortunately, the COMEX and the CFTC don't think it's a good idea to update this stuff real time, even though they could, and it wouldn't cost really any more money for them to do it, maybe a little bit more. But this is part of their whole scheme to try and make the market as opaque as possible without looking like they're trying to make it opaque. I mean, they do release the data, so maybe we should be grateful for that. However, you can see here, this is the managed money, which is hedge funds and CTA funds. And this is their position in COMEX gold as of October 25th. And you can see they're net short 38,000 contracts. Now that translates into 3.8 million ounces of gold, or 107 tons of gold. And by the same token, and I didn't show the change, but I think the hedge funds threw on something like 11,000 more gross shorts in gold last week, and that was absorbed by the banks covering their net long and reducing their net short, as well as the producer, the commercial category, which are producers and users and things like that. And they've been also aggressively covering their net short position. It would be natural for them to be net short because they're hedging out their use or their production of the actual physical metal. And I also wanted to just throw silver in here so you can see it. I mean, the hedge funds are net short about 8,000 contracts. They've been more net short that over the last few months. And the banks, of course, are net long 15,000 silver contracts, which is quite a bit for them. Now, just to circle back to the short position for that's being run by the hedge funds, the gross short, as you can see, is 110,000 contracts, 110.8, and that translates into roughly 11 million ounces of gold, or 311 tons. And this is about equal to the amount of gold that's in the registered category in COMEX warehouses. So if who's ever on the other side of those contracts decides to stand for delivery, it'll wipe out the COMEX gold that has been designated as available for delivery. Now, the total gross position across all of these accounts is, of course, 456,000 contracts. And that's 45.6 million ounces of gold. And that's 200% of the total amount of gold in COMEX warehouse stocks. So I just wanted to show these numbers because the amount of the paper short position, the gross paper short position on the COMEX, could cause a real problem for the COMEX. And it won't take, the long side standing for delivery of even half of those contracts for there to be a problem. There's going to be a problem if we get a delivery period where maybe just 5% of the longs stand for delivery, because most of that eligible gold isn't necessarily available to be designated as registered. It's just being held by investors who choose to safekeep their gold and silver in the COMEX, because the COMEX offers significantly reduced storage rates for a reason, so that they can have use of that gold while it's sitting there, than private depositories do. So I just wanted to, encourage everyone to hang in there. I mean, the massive short squeeze that we've been talking about in our community for a while now it's coming, and it's getting closer, and no one knows for sure when it's going to happen. It's just like in the fall of 2008, all of a sudden gold and silver started taking off at the end of October. And if you look at a chart of the price of silver, you'll see that, it's been outperforming gold, and it's well off its bottom percentage wise. And it looks like it could be starting an uptrend. Now, it would be unique for silver to lead the way in a sustainable bull cycle, which could last a few years. But, I don't care which metal leads the way, or even if the mining stocks lead the way. I do think we are going to see something within the next 3 to 6 months that will increase your level of optimism, my level of optimism, that we're going to see a big move higher in gold and silver, and the mining stocks will follow. God knows that the fundamentals there, regardless of what the Fed's doing with interest rates, are in 100% support of a massive move higher in the precious metals sector. And it's just one of these times when, as Jesse Livermore is famous for saying, you just have to sit tight and be right. So I hope everyone has an enjoyable rest of the week, and I hope everyone had a fun Halloween. and I'll see you again in 2 weeks.
Well, thank you, Dave, as always, for the update. Great video once again. And I know people really enjoy hearing from you every 2 weeks. Certainly is a pleasure for me to have you as a part of the show. Things that Dave knows and all of his experience studying these gold and silver markets, quite impressive. Hopefully at home you found that one helpful. And before we wrap up, did have a bit of news to pass along, as Fortuna Silver did have an announcement out Wednesday morning reporting that construction at their Seguela Gold project now 83% complete. Perhaps most importantly, they remain on time and on track with the budget, scheduled still for the first gold pour in mid-2023. A couple quick highlights here. As I just said, 83% complete, first gold pour on target for mid-2023. Deliveries continue to Cote d'Ivoire for all of the mill components, which have now been shipped. Last mill package due to arrive in early December. Process plant, structural, mechanical, and piping contractor have advanced work on multiple fronts. Also, a 90 kilovolt transmission line and substation nearing completion, on track to be energized in December. 565 cubic meters of water are collected in the storage dam, which is in line with expectations. Earthworks and high-density polyethylene linings of the tailing for storage on track for completion before the end of the year. And the mining contractor mobilized to site and has commenced establishment activities. So again, just great to see that Fortuna following through, and certainly Jorge Ganoza, who will be on the show next week to discuss their earnings next Thursday, November 10th, certainly has quite a lot of experience. Fourth generation miner, has been doing this for a while and certainly paying off right now as the construction of their mill is going quite well. So thanks again to Fortuna Silver for bringing us today's episode with Dave. Hope you're having a great day out there, and we will see you again tomorrow with Rafi's Weekly Silver Report.